Welcome to my webinar on buying a home in 2021. So thank you all for joining me. This is streaming on Facebook as well. So if you have questions and you are on Zoom, please feel free to post your questions on Zoom. I'll be paying attention to the Zoom chats throughout the presentation. If you are watching on Facebook, I'm not going to be paying attention to to Facebook chat, but feel free to post questions on Facebook, or if you're watching this later on YouTube, post questions and I'll be happy to get back to you later. So let's dive in. I've got a lot to cover in an action-packed, no more than an hour, but we're going to cover a lot of super good information and help you get prepared for buying a home in 2021. All right, so let's talk about interest rates for a minute. Here's where interest rates are right now. We've seen a pretty sizable change in interest rates just in the last few months. February and March have been the largest increase I've seen in interest rates in over 4 years. Now, there's a lot of perspective you got to put in here on what is a high interest rate compared to where they were. So let's take a quick look. Conventional 30-year fixed loans last week were around 3.375. 3 months ago, back in December, we were at 2.75. So that's over a 0.5% increase. Same thing with 15-year loans, we're about 0.5% up. FHA and VA loans are as much as 1% up in interest rate. But again, a 3.25 to 3.375 interest rate, super good from a historical perspective. It's just we were spoiled over the last 12 months with the best rates that we've seen in years. Jumbo loans have gone up by about 0.5 to 0.75% as well. So jumbo loans are anything over the conventional limit, depending upon the county that you're in. In the Central Valley, that's about $548,000. In the Sacramento area, it's $598,000. And in the Bay Area, it's like $10 trillion. I'm just kidding. It's like, I don't know, $800,000 or something in the Bay Area. Anything above that is a jumbo loan. So what's really happening with interest rates, and this kind of gives you some perspective of what we've seen with rates since January of 2020. And they were up in the high 3.5, 3.75% range. And you see it's been a very volatile ride down. It was flat, and now it's a ride back up. What I want to point out, though, is you hear on the news every single week, you probably heard it today, about, hey, this week's interest rate is blank. And it's because Freddie Mac runs a weekly survey where they ask lenders on Monday what this week's interest rate is, and then they publish those results on Wednesday or Thursday of every week. And so the black line represents Freddie Mac's weekly survey. That only takes into account purchase transactions and interest rates on purchase loans. Refinance interest rates are higher rates. About 6 months ago, the federal government decided to charge a premium and that people pay extra for refinancing a property. And B, some people are pulling cash out of their property, and that makes the rate even higher. So the actual interest rates that people are being charged are often higher than what's published on the news for two reasons. One is that purchase versus refinance, but the second has to do with the fact that this report is 3 to 4 days old. Therefore, it lags behind. So if you notice the report here, it was reporting a little bit below what the real market rate was. And then as rates started to drop, the real rate dropped faster and the reporting couldn't keep up because rates were dropping every single day. And now what we're seeing is rates are going up a lot faster than the news is keeping track. So I bring that up just to be aware, if you're buying a home in 2021, and really at any point in time, don't take what you hear on the news as fact of what your interest rate is going to be. A lot of factors go into interest rates, but recognize we're still really good rates, significantly lower than we were even in March and April of 2020 when we had a huge drop. We're right around that same level right now. Now, the biggest question I get from everybody is, John, where are interest rates going? And I want to give you some perspective first. We're going back to 1975 here. Rates were at a 9% interest rate, and they shot up in the early 80s all the way up to almost a 19% interest rate. And what happened every time that rates fell is people said, oh my gosh, we went down to below 13%, and they came back up to 15%. And they said, we're never going to see a rate below 13 again. It's going right back up to 19, and it didn't. Then it fell down below 10%. And it went back up above 10%. And everybody said, oh my gosh, we're never going to see rates below 10% again. Single digits are gone forever and ever. And that just isn't true. when historically rates have been moving down, and it's because of the market economy and efficiencies in the marketplace, and the fact that very simply we're highly productive society, and the cost of doing business has continued to go down over the years, and that has continued to drive interest rates lower and lower. So even right now, when we got below 3%, now we've moved above 3%, and everybody's saying, oh my gosh, we're never going to see a rate below 3% again. I don't agree. We're going to see interest rates again below 3%. We may not see them this year. So if you're buying a home right now and you think, oh my gosh, I missed out on the best possible interest rate, I don't think so. I just think you're going to buy your house right now. You're going to get whatever the rate is today. And my guess is in the next 2 to 4 years, we're going to see the cycle come back down. And if you look at this pattern, when they go down and they come back up, they go down even lower than where they were previously. And that's continued to happen over and over and over again. I don't expect that pattern to continue. But what's happening right now is rates are going up because of perception. The perception a year ago was COVID was going to crash the economy. Everybody, sky was falling, everybody was Chicken Little, and COVID was going to cause the economy to crash. And that created high volatility, and it drove interest rates down significantly, very quickly. And now we've got the opposite effect happening. If the fear of what COVID is going to do to the economy, how bad it's going to get, drove rates down, then the truth is increased vaccine rates and a decrease in the case count is driving interest rates up, because the economy is not, the markets are not worried about the economy being drugged down by COVID. The only wild card is that you've got some different variants of COVID that are out there that could create some unknown pieces, but I expect interest rates to stay steady in a slow upward movement over the next 6 months or so. I think we're not going to see huge inflation. I don't expect that to be a major issue. A lot of people are saying rates are going up because of inflation. I think it's partially true. Rates are going up because of the fear of inflation, but I really don't think inflation is going to happen. If you want a better understanding of why I think that, feel free to give me a call. I'm happy to talk about it, but I won't bore you today on my thoughts about inflation. What I want to explain today really is I expect interest rates to stay in the 3s. I think we could tickle the 4s, in the coming 6 to 18 months, but I think we're really not going to get above the mid 4% range. I think that's our high water mark. And again, each time that rates went down, if let's use this 5% mark as a line of demarcation, 2003, we got close to it. 2008, we finally broke through and we were tickling that level. We got down below it in 2010. Rates touched back up to 5%, way below it to 3.25. First time we ever saw 3.25 in 2013. And they went back up to around 4.5. And then in 2018, rates shot up to about 4.9%. We've never seen an interest rate above 5% since approximately 2009. I don't expect us to ever go back there. So we're going to hover probably in the high 3s to low 4s until the next cycle where the market starts dipping down a little bit. So hopefully that gives you a little bit of comfort. I know a lot of people were hoping they were going to catch the market at the absolute bottom in interest rates. And the truth is we've passed that mark, but this is not your last opportunity to take advantage of super low rates. All right. So now let's talk about why you're here and what does the real estate market look like today from my perspective. First of all, 2 major factors going on. Competition super high. Why is that happening? Remote work is part of it. We've got a lot of people who now can work remotely, and so they're not tied geographically to their driving distance to their office. So you've got a lot of people that are migrating to the suburbs, and in some cases migrating to other states. And I don't want to get political here, and I'm sure that a lot of you have your political leanings, and that's okay. The fact is, there's a lot of people who are moving out of California. There are a lot of people who are moving into California. What we're seeing in the Central Valley is we're seeing people migrating from the Bay Area out to the Valley. We're seeing a lot of people who live in the Valley that are moving out of states. The truth is, it's a national problem right now that competition is super high, and historically low interest rates have not helped the competition issue. Everybody wants to get into a home before rates go up even further. So it's created a frenzy, and that's what we're dealing with right now, is a frenzy of buyers that are all trying to buy very few homes that are out there. Before I get to the inventory issue, I'll tell you the last piece, in my opinion, that's really driving the frenzy of competition is the strong stock market. Stock market's done super, super good over the last year. People, when they see money in their investment accounts, they're more willing to spend money. They're more willing to invest that into home ownership. And there's certainly some people who are saying, hey, I think I'd rather shift some of my gains in the stock market over into the housing market and get a tax write-off at the same time. So there's lots of factors playing in here. The fact is competition is the highest I've seen in my 20-year history of being in the lending industry and paying close attention to real estate. We've got high competition. Inventory is super low. Here's what I think is going on and why there are so few homes for sale. First and foremost, I think there is a factor of forbearance holding back inventory. Let's rewind back to March of last year. There was a large segment of the population that lost their job. Typically, it was the service workers, people who worked in the restaurant industry, people who worked in the entertainment industries, and those people are homeowners. Those people in a normal cycle would have lost their home. They would have, now they might not have had it foreclosed upon, but they couldn't afford to make the monthly payment when they lost their job. And because there's significant equity in homes right now, they would have sold it, and that would have created inventory and they would have become a renter. But the federal government stepped in. And again, mixed emotions, and everybody can have their own opinion about whether it was good or bad, but it's a fact. The government stepped in and said, we're going to grant forbearances. We're going to grant anyone who says they were impacted by COVID the ability to postpone or skip making their mortgage payment for anywhere from 3 to 12 months. Well, that 12 months is coming home to roost. A lot of people got a forbearance and they have not made a monthly payment in the last 12 months. So now you've got to wonder what's going to happen with all of these people who have been in forbearance, they haven't made a monthly payment, and now they can't afford it because they still haven't gone back to work. I know a lot of restaurant owners who are still struggling. I know a lot of restaurant workers who are still struggling. You know, we talk about the economy opening back up. I don't think 25 to 50% occupancy in a restaurant is considered fully open, and people are not earning the income that they've normally earned. So you've got to wonder, I have got to wonder, what is going to happen with all of these people who are in forbearance and don't have a job to be able to make their payment? There's a big argument to be made that that's a wave of foreclosures or what we call distressed sales that are going to hit the market. I don't think it's going to happen. I think that first and foremost, the federal government is pushing the banks to do anything they can to help people stay in their homes. I think the government has made it clear, and the banks learned their lesson back in 2008 when the last crash happened, that they don't want to be looked at as the big bad bank that took away somebody's home. And so the banks are doing everything they possibly can to keep people in their home through what's called loss mitigation solutions. That's ways to stop people from or decrease the monthly payment that they have. If somebody skipped their mortgage payment for the last 12 months, somebody skipped the mortgage payment for the last 12 months, then they're taking that payment and putting it onto the end of the loan with no interest charged whatsoever. So that person has been maybe collecting unemployment. They've got a good amount of money in the bank, hopefully, that they've been building up because they haven't made a mortgage payment in the last 12 months. And now they don't have to repay that money. That gives them a little more time to now be able to make their mortgage payments out of that savings. They're not going to give up their home. We're not, in my opinion, going to see a huge wave. We are going to see a trickle. We're going to see some people who are going to say, you know what, I would just rather downsize. I'd just rather make a move now that I'm out of forbearance and I don't feel comfortable not knowing when I'm going to have work and be able to make that payment. So I do see us seeing some additional inventory coming out over the next 3 to 6 months, but they're not going to be foreclosures because housing prices have gone up so much over the last year, so much over the last few months. These people have a huge amount of equity in their homes. So we're not going to see really any foreclosures. We always see some. We're not going to see a glut of foreclosures. We're going to see people who had been in forbearance that are going to put their house on the market, sell it as a traditional equity sale. It's not going to look any different. It's just going to open up a little bit more inventory. So what's the second reason why inventory is low? To me, I believe it's sellers that are unwilling to sell during COVID. You've got a lot of people who are concerned about having buyers walking through their home. Maybe they're immune compromised, or they have concerns about what would happen if they got COVID, and they just don't want to list their home for sale. And for a lot of those people, we're not out of the woods yet. So once again, vaccine rates get better, then I think we're going to see some opening up of those people willing to sell their home, and that will help with some inventory issues as well. But here's the big one to me. You got sellers that don't want to list their home for sale because they're afraid they cannot find a replacement property. I am talking to people every single day who are afraid to sell their current home because they see how hard it is to get an offer accepted right now. And they're worried, I'm going to sell my house and I'm going to be homeless. And those people have a house to sell. They're exacerbating the problem, and it's not their fault. They have a house to sell and they want to sell it. And if they sold their house, if collectively all of those people put their house on the market to sell it, the logjam would free up, because all of those homes would be listed for sale. Each of them would almost be trading homes. Hey, I'll take your house because I'm upgrading. Perfect. I'll take your house because I'm downgrading. That's not that simple, but in theory it is. But every one of them is fearful. Hey, I can't see that I'm going to be able to find a home that suits my needs and get it in contract. I don't want to list my home for sale and end up potentially homeless. Even if you do list your home contingent upon the sale of finding a replacement property, that is a good strategy, but there's still got to be an exit strategy. There's still got to be a point in time. You got a buyer who you've said, hey, I'll sell you my home as soon as I find another house that I can buy. You can't keep that buyer on the line for a year. So you kind of got to figure out at some point you're cutting bait, and that's either cutting bait by not selling the home, which means you didn't really solve the inventory problem, or you sell the home and you end up renting, which is a bigger risk about where the market's going and whether you even want to be a renter. So these are really the challenges that we're facing in today's market. And I want to talk through some of the things that I think we can do to help overcome those challenges. But before I do that, I get a lot of questions from people saying, John, are we in a bubble? Like, prices are going up significantly compared to what we saw just a few months ago. And aren't we creating the same bubble that we had back in 2005? And my answer is no, I don't think we are. And there's multiple reasons why. The first reason I'll tell you is the 2005 bubble was caused by poor loan standards. We gave a loan to everybody, and we gave poor quality loans as well. So it was kind of the mirror test, right? If I could put a mirror under your nose and the mirror fogged up, you got a loan. And that meant that you might not actually have the income to make that payment, but the industry just figured, well, if you got good credit, you'll figure out a way to make the payment. And we all saw that didn't work very well. The other piece that really caused the collapse back in 2007, 2008 was what I call the domino effect due to adjustable rate mortgages. I want to be super clear. Today, a majority of the loans that are out there are 30-year fixed rate mortgages. But back in 2005, lots of lenders were doing a lot of adjustable rate mortgages. And that meant that your interest rate was going to adjust in 2, 3, 5 years, and your payment was going to go up significantly. You had to refinance, or you couldn't afford to make the new payment. So when one person on your block foreclosed and the housing price dropped, then the next guy down the street who had to refinance, not because he wanted to, but because his payment was going up, because his rate was going up, he had to refinance. That person couldn't refinance because values had dropped. So they had to foreclose. Now the dominoes keep falling. The next guy on the street, the house values dropped even more. They can't refinance. They go into foreclosure to cause house prices to drop even more, and so on and so on. We're not going to experience that. Even, by the way, this market will turn. First thing it'll do is it'll stop going up like this, and it'll flatten out. And we're going to get a little bit more of a balanced market. And then at some point in time, prices are going to come down some. That is absolutely a fact. The thing that I fear the most is the human condition, the human expectation that whatever is happening today will continue to happen forever. And it's psychological. You think, oh my gosh, everything is great. I'm doing really good, and the market's going up, and I'm making money in the stock market. Let's invest all our money in stocks. That's not a good idea, okay? But when everything is bad and the markets are doing bad, oh my gosh, let's sell all my stocks, the market's doing bad. That's not a good idea either. Because no matter what is happening, whether things seem rosy and great or things seem bleak and horrible, everything in life is a cycle and it'll turn around and go the other direction. It just won't go the other direction as bad as you fear. When housing prices drop, I don't expect them to drop anywhere near as much as what we've seen. Just like when interest rates go up, they're not going to go up anywhere near as much as what you fear. But the key is understanding that at some point in time, prices will drop some, and when they do, we're not going to have that domino effect. Today's rise in prices are really based on some fundamental shifts. And the biggest fundamental shift is the generational demand. I feel like we have probably 5+ strong years of demand on housing prices. And the reason why I say that is because if you look at generations, the baby boom generation had been the largest generation, and the population 69.56 million people born between 1946 and 1964. Then there's Generation X, the smaller, forgotten generation, and then the millennials came along. And the millennials are larger than the baby boomers. But here's what the millennials did different than everybody else. When they graduated college, they decided they didn't want to be an adult, right? Adulting, nobody wants to do that. So they all went back home and they lived in their parents' basement. I don't know about you, but my parents didn't have a basement. Anyway, they lived in their parents' basement, and now those millennials are getting to be in their mid-30s. They're deciding, maybe I want to get married and have kids, and that doesn't seem like a fun thing to do in my parents' basement. So we've got a big generation of people that postponed getting married, they postponed buying a house, and they postponed having children until later in life compared to prior generations. So there's a gap over the last 10 years of people that generationally should have bought homes and they didn't. And that generation is now catching up and saying, wait, I'm ready, it's my turn. And we don't have enough housing stock. We don't have enough inventory. We don't have enough homes to fill for all of those people, all of those families that are being created. It is the millennial generation that, in my opinion, is going to continue housing market being strong. I'm not telling you it's going to keep prices going up like they are right now, but I am telling you it's going to keep housing prices strong. We're not going to see this huge bubble bursting because these people need homes and they're going to continue to buy homes and eat up the inventory that's out there. So I don't expect us to have any kind of a big shift. And I think I talked before, but I already mentioned this. Nothing is forever except change. So that whole thought process that everything is going to stay the way it's going right now is just not true. So I got ahead of myself and I covered this slide earlier, but the point is it will slow down. It'll slow down as we get more inventory, pricing increases. The craziness that's going on right now will slow down once we get more inventory and as rates start moving up. Because the truth is there are some buyers I'm talking to that are just emotionally drained. And that's the hardest part about buying right now is you've got to be willing to stay detached from the property because there are so many people trying to write offers on so few homes, and you get attached to that property emotionally, and then you don't win the offer, and you do that 3 or 4 or 10 times in a row. There's a certain point when you just can't do it any longer. That's when we start seeing some buyers say, you know what, I'm going to sit on the sidelines for a little while and just wait this one out. So that's what we're going to see that's going to cause this craziness we're dealing with today to slow down. When is that going to happen? I don't know. Just like telling you exactly where interest rates are going to go, I don't know. If I knew that, I wouldn't be talking to you guys tonight. I'd be a multimillionaire. But here's what's happening in today's market specifically. You have to win the offer. Okay, this isn't a, let's pick what house I want and let's think about it for a week and decide if it's the right one in the right neighborhood. It isn't, oh, I'm giving the seller what they asked for. This person wants $450,000 for their home. And yeah, I think I'll pay that. That is not what we're dealing with in today's market. So as a buyer in today's market, what you need to understand is you have to win the offer. We're dealing with urgency to buy now because there's rapid appreciation and rising interest rates, and people are seeing that and saying, I need to buy now before rates go up higher. and before prices continue to accelerate even higher. That's exacerbating the competition and driving people to write offers significantly above the list price of the home and significantly above what the prior home had sold for. So it is absolutely tougher to get your offer accepted, and bidding over the asking price is common. The problem is appraisals. The appraiser is required by lending standards to look in the rearview mirror. So you're all looking, you talk to your real estate agent about how much should I sell my home for, and they're going to say, well, your neighbor's home just closed for $450,000. So prices are moving up pretty significantly. Let's list it for $470. And I think there's a good chance we might get it bid up from there. But that's the realtor appropriately looking out the windshield and saying, this is where I see we're going, and this is where we should go to get ahead of the market and appropriately price your home. But the appraiser has to look in the rearview mirror. They have to look at homes that have closed escrow. And the home that closed yesterday went into contract 15 to 45 days ago. The market is moving up so fast, prices that people were willing to pay 15 to 45 days ago are a lot lower than prices that somebody's willing to pay today. So the challenge comes up for the appraiser to try and justify the price you've paid for the home. And this has a lot of buyers asking me, John, I don't want to pay over market value. And I tell them it's impossible to pay over market value because your purchase of this home defines the market value. Think about that for a second. The definition of market value is the lowest price the seller is willing to pay to let it go for meets the highest price a buyer is willing to pay for that home. So you have to win the offer to buy a home. You have to be the person willing to pay more than anybody else is willing to pay. Now, in a normal market, there might only be 1 or 2 people writing offers on that home. In today's market, there's 20 or 30 or more people writing offers on that home potentially. And you, by being the person that won the offer, likely there's many things that go into them deciding which offer to accept, but likely it is coming from you're the highest price on the person willing to pay the highest price. Well, guess what? That means you've defined the market value. You cannot pay over market value. You created the market value. You're a trendsetter. But the appraiser can't justify that. And just realize, you say, well, wait a second, there's other people who are willing to pay this because the guy yesterday who wrote a contract went into contract at the same price for a similar home as what I'm buying. And that's true. The problem is the appraiser can't use that sale until it closes. And that home isn't going to close until around the time your home's going to close. So it creates a challenge with appraisers being able to justify the increase in market value because they're handcuffed by lenders' requirements. And it's not Summit funding, it's not John King, I wish I made the rules. It's really the federal government, Fannie Mae and Freddie Mac, making those rules. So I want to talk a little bit now about what happens if an appraisal comes in low. This is a pretty serious concern, and it's a conversation that people are having over the dinner table every single night right now that are looking to buy homes. So let me run through some numbers with you to help you understand this. If you're buying a traditional 20% down on a $500,000 home, so your purchase price is $500,000, and you're putting $100,000 down, and ballpark with closing costs, you're looking at about $115,000 out of pocket. Payments $2,450, today's $2,435 at a 3.375% interest rate. But what happens if that appraisal, maybe that house was listed at $450 and the appraiser couldn't justify the increase to $500, and the appraiser says, you know what, I can only justify this house being worth $475. What normally happens, good news is I have better solutions, so don't tune out. What normally happens is the lender says, okay, well then I have to base your loan amount on the lesser of the purchase price or the appraised value. So because the house is appraised at $475, you want to put 20% down. That means that you're putting 20% down on the $475. I'm only loaning you $380,000. You are coming up with significantly more money out of pocket on your purchase because of the fact that the appraisal came in low. And what if it comes in even lower? The value comes in $50,000 low. Now you're coming in with an extra $20,000 out of pocket. Now your payment goes down a little bit, but you were planning on $110,000 to $115,000. By the way, I realize there's a typo in this number because it should be about $10,000 in closing costs. And if you do the math, you'll realize that. Anyway, but you're looking at if the value comes in $25,000 low, you're putting an extra $20,000 out of pocket. Comes in $50,000 low, you're putting an extra $40,000 out of pocket. And most people just don't have that money. If they had $40,000 extra to put out of pocket, they would have started with putting that $150,000 down. So how do we deal with this? Well, a couple of things. The good news is if you're putting a large down payment already. Let me give you an example of you putting a 40% down payment because, hey, I have $210,000. There you go. The math is right on this one. So $200,000 down plus $10,000 in closing costs. All right. So you say, I have $210,000 to put down towards a house, but what if the value comes in $25,000 low? Nothing changes. I can still loan you the $300,000 because you're still putting a large enough down payment that I don't have to charge you mortgage insurance. And that's what most people are avoiding. That's why people want to stick with the 20% down. If the value comes in at $50,000 low, it still doesn't matter. I can still loan you the same $300,000. You notice your monthly payment didn't change. Your cash out of pocket didn't change. The only thing I caution you about is the only problem is your perception. You are going to perceive that you've overpaid for this house. You're going to perceive that, John, I don't want to pay $500,000 for a house that's only worth $450,000, even if you said I can have the same interest rate with the same payment and the same cash. I don't want to buy a house for a house worth $450,000 and pay $500,000 for it. Remember what I said earlier, the appraiser's looking in the rear view mirror, and as prices are skyrocketing, the appraiser sometimes cannot justify the increase in price using homes that have already closed, and they're not allowed to use homes that are under contract as the factual basis of what your home value is. So you need to understand you are setting the market value. You're not paying over the market value. Okay, John, that's great. I know if I have a large down payment, it doesn't impact me very much. But let's look at reality. Is there a better solution when I'm only putting 20% down? And the answer is yes. Remember earlier I said if your appraisal comes in $20,000 low, this one added up correctly. So ignore the one earlier where it said $115,000 cash to close. It correctly shows the 110 this time. So $500,000 purchase price. Same example we looked at in the beginning. You're putting 20% down. You are putting $110,000 out of pocket. Remember, when I showed you a few minutes ago, if your value comes in at $25,000 low, then you had to put $130,000 down. And I'm here to tell you, you don't. You only need to put $112,000. You're putting an extra $1,700 out of pocket, and you get exactly the same monthly payments and exactly the same interest rates, even though the value came in low. That is a secret I'm never going to reveal. No, let me show you how that works. How it works is very simply because you're now borrowing 84% of the value of the home. Remember, the house value is now $475,000, so I'm treating your down payment as $75,000, $75,000. Now you still have to cover the other $25,000 because you're buying the house for $500,000 from the seller. So I just added that over here in closing costs. You're adding an extra $25,000 to the closing costs because that's not really a closing cost, but it's extra money you're paying to cover the gap of the appraisal. But remember, your down payment went down by $25,000. Your appraisal shortage is the $25,000. The only difference is you are prepaying the mortgage insurance as a one-time fee. With really good credits, it can be as little as a $1,700 cost. About a little less than 0.5% of the loan amount is what it's going to cost you as a one-time fee. That is significantly better than coming up with an extra $20,000 if the house comes in $25,000 short on appraisal. You're only coming up with less than $2,000. What happens if the value comes in $50,000 low? You still can do the same thing, but now you're adding about another $1,300, $1,400 on top of that in fee. So remember, the scenario that most people, most lenders, most of my peers will tell you, hey, your house came in $50,000 low. I need you to come up with an extra $40,000 out of pocket. I'm here to tell you that's just not the only way to do this. I can do this by charging you $3,000 of a one-time mortgage insurance fee, because now you're borrowing almost 90% of the $450,000 value. But remember, what you're really paying attention to is how much is my monthly payment going to be and how much cash do I need? And it's a very small difference in the amount of cash you have to come out of pocket with, and you have exactly the same monthly payments, even if the appraiser could not justify the increase in purchase price. Now, what if you're only putting 10% down? It becomes a little bit trickier when you're only putting 10% down, but I can still solve the problem for you. So you're saying, hey, I'm buying this house for $500,000, and I want to put $450,000 as a loan amount and only put $50,000 plus closing costs. Okay. But what if the appraised value comes in at $475,000? I can do the same thing. I can keep your payment the same. Your cash to close only goes up a little bit. And if it comes in at $450,000, you're going to say, wait a second, John, I can't do a $450,000 loan on a house worth $450,000. And you're right, you can't. But now I can leverage down payment assistance program. And you do not have to be a first-time home buyer to utilize down payment assistance programs. So I can help you to purchase this home for $450,000 value, even though it's a $500,000 purchase price, and you're still coming in with the same, actually coming in with a little bit less money. Now you're going to get two separate loans. You're actually three. You're going to get the primary mortgage, but you're going to get two additional down payment assistance loans. Those down payment assistance loans are going to be about $23,000 worth of loans that you have to pay back when you sell, when you refinance, or in 30 years when you pay off your primary mortgage. But you don't have to make any payments on them. There's only a little bit of interest added to it. So when it comes to how do you solve the problem of a low appraisal, even if you don't have a big down payment, we could still bridge that gap. And again, oftentimes it might come down to using down payment assistance, but it is using the same scenario of one-time mortgage insurance until I get to the down payment assistance. With down payment assistance, I'm switching to an FHA loan. There's some changes to how the structure is, and your payment is definitely going up. So that's the thing you be clear about. This down, all of the other scenarios was a little bit of a bump in your upfront cost and you were fine. The down payment assistance scenario is a pretty sizable bump in your monthly payment, and there's a sizable amount of money that you're borrowing as the assistance that has to get paid back later. So I don't want you to misunderstand. This is kind of our last option that we would go to, because it definitely changes a lot more of the terms. But until we get to this point, we're in great shape with any of these other options that give you only a little bit of a bump in your cash out of pocket, and it keeps your monthly payment the same. All right, I've been going up for a long time. I have more stuff to cover, but I want to make sure that you guys know if you have questions about anything, please feel free to post them into the Zoom chat. If you have something you want me to cover, I'll cover it there. If you're on Facebook or YouTube, I'm not going to be watching those comments, but feel free to post them there and I'll get back to them later. All right, moving along. What if you currently own a home? I have a lot of people who are saying, John, this is all great, but I can't buy a house in today's market because I've got a house to sell. And sellers are not accepting contingency. Well, the first thing I'll tell you is let's have a conversation about love it or list it. So don't tell your realtor I told you this, but sometimes you just kind of say, you know what, if I just make some changes to my current home, I can love it enough to stay there. And that's not a bad thing. I'm not talking you out of selling. I'm not talking you out of making a move, but I'm telling you, be realistic and say, hey, maybe I can make my house work for me. So I'm going to give you an example here where you have a house worth $436,000, and maybe you took out the loan in 2018 and you have a high interest rate on it. So you could say, hey, you know what? I'm going to refinance that right now, and I can save myself $250 a month, and I can use that $250 a month to maybe do some stuff around the house and pay down some debt and maybe make my life a little more comfortable where I'm at. But what I'm finding more often is people are talking about remodeling. Maybe you want to remodel your kitchen and stick around because you want to make that move to get a nicer kitchen. And again, real estate is about location, location, location. So if you're not in the right location, make the move. If you're in the right location and you just kind of said, hey, maybe I want to move because I'd like a nicer kitchen, well, maybe you're better off staying where you're at and upgrading your kitchen. And in this case, if you have a higher interest rate from a couple of years ago, you could pull about $45,000 out of your home and your payment would stay almost the same. So it is something to think about if you own a home right now and you're just concerned about, hey, housing prices are going up, I'm going to reset my property taxes at a higher price. It is worth looking into cashing in on that increase in value by pulling some money out and remodeling your home. But let's pretend you said, nope, John, I'm making a move and I think that's a great idea to make that move. How do I make it happen without being contingent? Here's what I'll tell you how. You buy the new house with just a 5% down payment. Okay. Now, that still requires some money. So let's say you're upgrading to a $525,000 home. That means that you're going to have to come up with about $37,000 out of pocket. Okay. But that's way better than trying to come up with $20,000 out of pocket. Maybe you can pull that money as a loan against your 401k. If you have, let's say this, most 401ks, if you have funds in there and you haven't taken out a loan, will let you borrow up to 50% of your balance and you pay back the interest to yourself. And you can pay it back pretty quickly because you'll pay it back once you sell your house. So you can, if you had $70,000 in your 401k, you could pull out $35,000 and cover this down payment. You've got a payment of about $3,000 a month, so it's bumping you about $900 a month over what you're paying today. But then you sell your home after you buy the new home. The next challenge, though, is you have to be able to qualify to pay your current mortgage payment and this new one. So there's some strategies there. If you list your house for sale and you list it contingent upon finding a replacement property and the buyer releases all of their contingencies, I can ignore the monthly payment on your current home when qualifying you to buy the new one. So that way you can buy the new home without having to have your current home sold. Or if you happen to have enough income to afford to make both mortgage payments, that makes this super simple. The final option is maybe you rent out your current home for a period of time, and we use the rental income from that home to offset the mortgage payment. Either way, this strategy plays out with you selling the home at some point in the near or not too distant future. Once you sell this home that was worth $436,000, you pay the realtor's commissions and you pay off the mortgage that you had of $298,000, you're going to have an extra $110,000 to put towards a down payment. You put that money towards the down payment, and here's a trick most people don't understand. It's called recast your mortgage. If you make a large one-time payment on your mortgage, you can call up your mortgage company and say, hey, I want to pay down my principal by $110,000, but I'd like for you to lower my monthly payment accordingly. They will do it. There's about $500 to $750 of processing fees that go along with it, but think about it. You put an extra $110,000 down, your balance drops from $498,000 to $388,000. Your mortgage insurance automatically goes away because now you have 20% equity in the property, and your payment drops by $600 a month. And you said, you know what, that's cool, because I knew I was going to have an increase in monthly payment when I go from my $436,000 home to my $525,000 home. And that $279 a month extra I'm paying is exactly what I expected to pay. You just have to be able to bridge the gap in the meantime with this $3,000 a month payment until you get your home sold. But I'll tell you what, in today's market, once you've got that home listed and you're ready to sell it, it's going to sell quickly. You don't need to worry about carrying both payments for very long. So that is a strategy that a lot of my clients are using to find a way to purchase a home today even when they have a home that they need to sell. So great way to look at it. I want to cover a couple of other considerations as I wrap up our conversation today. The first thing I want to talk about is contingencies. You need to talk to your realtor about contingencies. I'll give you my side from a lending perspective. So writing offers today, if you were a seller and you had somebody that said, hey, I'll give you $500,000 for your home and I'm going to pay cash, I'll close in 10 days. Well, guess what? That means you don't have to worry about that buyer having an underwriter looking at their loan and deciding there's a problem. You don't have to worry about that buyer having an appraiser looking at their property, your property, and saying, oh, it's not worth that much, and the buyer doesn't want to proceed. And you, as a buyer who doesn't have cash, are likely competing with some people with cash. Now, that cash buyer, if they're writing an offer for exact same amount as you're writing an offer, they're going to win every single time. But if you can strengthen your terms, and there's lots of terms you can strengthen. So loan contingency is one of them. And if we're needing to release loan contingency, I have done that for many of my clients because we get your file fully reviewed. We're confident that everything is good. What I'll tell you is confident does not mean guaranteed. There are things that are pulled at the end of the process that can come up. It happens maybe 1% of the time. What you're risking is your earnest money deposit. When you write an offer on a home, you and your realtor are going to choose how much money you want to put as an earnest money deposit. And that's you telling the seller, hey, I've got skin in the game here. I'm not going to walk away. If you cancel your transaction without meeting one of these contingencies, or if you don't have any contingencies, the seller can keep your earnest money deposit. So that's what you're risking if you go in without a loan contingency. What I'll tell you is I fund 99% of the loans that I start. It is rare that we run into a problem. So if you're in a highly, highly competitive situation and you say, John, I need to go in with no loan contingency, I'm going to warn you that I cannot guarantee that we're going to have success, but I can dot every I and cross every T and double check everything. And in a few days, I can give you confidence that yes, we're in good shape. You can release your loan contingency. The second contingency that matters is your appraisal contingency. That one, gang, I have no control over, but what I will tell you is there's a secret that many people don't understand, and it's called appraisal waivers. And it's really just a computer with Fannie Mae or Freddie Mac's programming that determines, do we feel comfortable with this transaction and with the purchase price of this home compared to other homes in the neighborhood? And do we feel comfortable enough to proceed without needing an appraisal? And I'm finding that a fair number of transactions are being approved without appraisal, with appraisal waivers. Now, I'll tell you, a year ago it was more because prices have gone up so much. I'm having fewer homes that are getting approved without needing an appraisal. But I just had one, as a matter of fact, I think the realtor on that transaction is on this call, that we got approved without an appraisal required. We got an appraisal waiver. So that buyer saves $500 in an appraisal fee, and they save the concern about whether the appraiser says the house is going to come in low. If you provide me the property address as you're writing the offer, and you ask me to run it through to see if we can get a waiver, I happily will do it. And that will allow you to write your offer without an appraisal contingency and without worry that you've released the contingency prematurely and you might get bit in the end. So it's a super important strategy to pay attention to, and I'm happy to run it through if you provide me your realtor provides me with the address of the home that you're going to write on, the loan amount you're going to do, and the purchase price. I can run it through the system and see if we get an appraisal waiver at that purchase price. The next thing we talk about is close of escrow period. Close of escrow period on a conventional loan or even an FHA loan, we're getting done in 21 days when necessary. So if you're in a situation where it's highly, highly competitive, talk to your realtor and make sure they're having a conversation with me about how quickly we can get your loan closed. And we will do everything we can to decrease the time frame, because the shorter you can write your close of escrow period, the better off you're going to be in getting your offer accepted. Now, I want to talk, before I get to the last point here on the page, I want to talk about other things you can do to sweeten your offer. So first of all, in many counties locally, it's customary for the buyer and seller to split the title and escrow fees 50-50. Then all of the other fees are typically paid for by the buyer, with the exception of transfer tax and maybe home warranty that are paid for by the seller. Nobody says you have to tell the seller to pay half of the title and escrow fee. Nobody says the seller has to pay for the transfer tax. You can write an offer and have the buyer, paying for all of those little fees. That makes your offer a cleaner, stronger offer that gives more bottom line proceeds from the sale of the home to the seller, because they're not covering those small amounts of fees. Another strategy I've seen people employ is a kind of a yes/no inspection clause. So some people, there's another contingency that's called the inspection contingency. All of these things I'm talking about right now, you need to talk to your realtor. I'm not a licensed real estate agent, but I do a lot of loans and I see a lot of things. So my goal right now is to introduce you to some concepts that you can talk to your realtor about. So you can write in a lot of people are nervous about releasing an inspection contingency because what if there's a problem with the house? Well, the seller might say, I'm not worried about there being a problem with the house, but the problem is some buyers come in and they nickel and dime you. They write an offer super, super high, and then they do an inspection and they say, oh man, you got to fix this and fix this and fix this. Let's lower the price. So I've seen some buyers write in the addendum that says, this is and get the wording from your realtor. If you're a realtor, get the wording from your broker. But basically, this is a pass or fail inspection contingency. We either will proceed with buying the home as is, or we will cancel within the appraisal contingency period, but we will not come back asking you to repair anything or to credit us for repairs. Think about what that says to the seller. It says, okay, if you as the buyer find major problems, I get it. You don't want to buy my house and be stuck with a major problem. I get it. But I know as a seller, you're not going to find major problems. I know there was a window that kind of sticks a little bit, and I know there's a leaky faucet, and I know there's a couple of other things that I'm just not willing to fix in this right now. And you know you're not going to get nickel and dimed by that buyer. So the pass-fail inspection strategy is a great strategy because it gives confidence to the seller you're not going to nickel and dime them. You're simply going to get your inspections done and proceed or cancel. There is no nickeling and diming. Another strategy to think about, again, talk to your realtor. If you're a realtor, talk to your broker, is the escalation clause. An escalation clause, depending upon the listing agent, may be viewed as a good thing and it may be viewed as a bad thing. But let me explain to you what an escalation clause is. An escalation clause has you saying, hey, you've got your house listed for $450,000. I'm going to offer you whatever. I'm going to offer you $470,000. But I'm willing to pay up to $525,000. Excuse me, let me say this a different way. But I'm willing to pay $5,000 more than whatever the highest offer is that you get, not to exceed a certain number. So you can put a cap on it, and you can say, hey, this house listed at $450,000. I'm willing to pay $475,000, but I don't want to lose out if somebody else offers $490,000. So I'm going to put this escalation clause in that says I'll pay $5,000 more than what anybody else is willing to pay, up to $5,250. And so the listing agent says, okay, hey, I got an offer for $490,000. Your escalation clause says you'll pay $5,000 more than that. That means you're paying $495,000 for the house, and you won the offer without having to write your offer at $495,000. Especially because you might have been willing to go up to $525,000, but you didn't want to go there if nobody else was going to be anywhere close. Here's the drawback. The drawback is a listing agent's going to say, if you're willing to go to $525,000, write your offer at $525,000. I'm not going to play games with an escalation clause. Now, I don't know whether the realtor can refuse the offer because it has an escalation clause or not. I'm not a real estate attorney. I don't pretend to play one on TV or on YouTube, but I will tell you that it is a strategy that I've seen a lot of people employ successfully. And it's something that you may want to have in your arsenal as you are navigating these waters. The last thing I'm going to tell you, remember guys, I'm wrapping up here in a minute. If you have any questions, feel free to post them. If you've asked a question in YouTube or in Facebook, I haven't paid attention to it live, but I'll catch it later. If you have a question and you're on the Zoom call, please feel free to post it right now because I'm almost done. And Charlene, the answer is yes, it's recorded. It's actually on my personal Facebook page right now. So feel free to go to my Facebook page if you're my friend. If you're not my friend, I must not like you very much. I'm just kidding. But feel free to go onto my Facebook page and share it. I'll also have it on YouTube tomorrow morning. So youtube.com/John Lone King. Okay, perfect. All right. So the last point I want to talk about is how many realtors should you have working for you? And I've got a lot of buyers who are confused and they say, you know what, it's a tough market out there. And my realtor just isn't finding me a home. So I'm going to get another realtor and have 2 different realtors shopping for me and helping me find a home. Because if I got 2 people shopping for me, I'm going to have twice the opportunity to find the home. Guys, that just isn't true. Okay. The truth is you're hiring your real estate agent to serve you in finding a home. And so first, it's an integrity thing. If you don't like your realtor, or if you don't think that your realtor is doing a good job for you, fire them. Tell them that it's not working out and you part ways. It happens. But the fact is, they are spending time taking you to all of these homes, showing you these homes, writing these offers. The realtor is working harder today for their income than they have ever worked in their entire career because they've written offers for you for 10 different homes that didn't get accepted. And then you turn around and write an offer with somebody else and that offer gets accepted. It was pure luck that that one got accepted with a different real estate agent. There is nothing secret that a realtor has access to secret inventory that somebody else doesn't have access to. Publicly marketed homes are available on the MLS. And be careful about shopping on your own and saying, oh my gosh, I saw all this stuff on Zillow. The stuff you see on those websites is not accurate. A lot of homes have already sold and it doesn't reflect that on the internet where you're looking at it. So definitely pick a realtor, fall in love with your realtor, and stick with that realtor until you get a home or you hate them, and then fire them and find somebody else. But do not have multiple realtors working for you because A, it's just not the right thing to do. B, it is not in your best interest. Because especially in today's market where it's highly competitive and hard to get an offer accepted, you got to make a decision quickly to go see a home. You need a realtor that thoroughly understands what you're looking for in a home. And when you go see the first house and you say, oh my gosh, I love this house, but the backyard is too small. And then you go to see the second house and you say, oh my gosh, I love this house, but the kitchen is too small. Well, because you have the same realtor, they understand, oh, they need a bigger backyard and a bigger kitchen. That's important to them. If you had 2 different realtors show you each of those homes, one of them knows that you need a big backyard, but they didn't know a kitchen was important because you didn't comment on the kitchen because it worked. And the other one knows that you need a bigger kitchen, but they didn't understand you needed a bigger backyard because you didn't bring it up because it worked. So by having 2 different realtors working on your behalf, you are getting a lower quality of service. You need to make sure that you have one person working for you. And it is, guys, I see it unfortunately more than I want to, where I've got buyers that are giving my contact information as their lender to multiple realtors. And I'm going to tell you, it is a disservice to you. It is a disservice to your real estate agent, and it is not going to help you get an offer accepted any sooner. All right, gang. That is all that I have got. So if there aren't any more questions, I really appreciate all of you hanging out with me for an hour tonight. Again, this will be on my YouTube channel tomorrow morning, youtube.com/John Lone King. Lots of great videos on there. And I don't just get paid for doing these amazing recordings, but I also get paid for doing mortgages. Actually, I don't think I even get paid at all for doing these amazing recordings. So if you need a mortgage, I want to be your lender. I am applying for the job. Give me the opportunity to help you. You can go to apply, apply.johnloneking.com. Apply.johnloneking.com. Fill in all your information, upload your documents. We'll get you pre-approved, and we will take amazing care of you. Thank you, everybody. I have 1 minute to spare. Hope this was a worthwhile hour. Have a great night, gang, and we will talk to you soon. Bye-bye.